I want to get your take on what we've been talking for the last day or so, right? This U.S.-Japan trade agreement or deal, and possibly one with the EU coming up very soon as well. Seems to lessen the risk that we are going to be tripping into a very bad growth patch, right? Which obviously matters to your business.
Good morning, Martin. Good morning, JP. Yes, no, that's absolutely correct. We are watching it closely to see how our occupiers, how our tenants are doing, especially in our commercial office buildings. But I would say for the first half of the year, after the announcement of the tariffs, etc., we've not actually had a single tenant come to us and say, look, we'll start downsizing, giving up space because of the tariffs. So all of them have pretty much said, look, we'll take a wait and see approach and see how things pan out throughout the year and then make a call on it, rather than take a knee-jerk reaction to it.
I got to say, I mean, part of this is also because of the assets that you have and the type of the REIT that you are, right? Mostly commercial, where WALEs or weighted average leases tend to be longer. The lock-in is safer, in other words.
That is true. Our WALE's 2.7 years, and we have 3 offices, and our focus really is in prime grade A office in the CBD. So that proves to be quite resilient, and that is really our DNA, and it runs through our DNA. We really focus on very prime core assets, such that during times of volatility, it holds up nicely.
Right. Let's talk about again. We mentioned diverging fortunes, it seems, because the commercial asset portfolio seems quite robust, actually. But when you look at the hospitality segment, you saw a decline of about 12.9%, if not mistaken, from revenue year on year. Now, it was attributed in the report that the relative lack or relative lower number of events in Singapore might have contributed to that. Do you think that's going to continue into the second half of this year? And was Taylor Swift really that important to you guys in the first half of last year?
Taylor Swift was massive. I would say Taylor Swift by herself had the equivalent effect of an F1 event in Singapore. So that was sort of the buzz it generated, and you could really feel it. And yes, last year we had a very high base, especially in the first quarter of the year. Now this year it was a lot lower. There were a lot less events, so we did see visitor arrivals come off a lot more than last year. If you look at pacing, the June numbers were out. We are circa sort of 8 million in terms of visitor arrivals into Singapore. The 2019 number was circa 19 million. So we are actually still off the pace of the 2019 number. And in Singapore, typically you'll see even years have more events and odd years have less events. So hospitality industry does go through, in Singapore in particular, goes through that slight cycle where odd years tends to do a little bit poorer, even years tend to do a little bit better. So there's a little cycle that goes on there.
Okay, Khim Siew, I wanted to ask you about your portfolio valuations, because in the full year results, when we talked about it last time you were here, it was actually indicated that there were fair value losses that weighed on the results. Now, if I'm not mistaken, that was also attributed to some of the China assets you actually had. Are you comfortable with the valuations of the portfolio right now, or do you think that could actually improve?
So for Singapore valuations, if we look through 22, 23, 24, our portfolio valuations held up firmly, held up nicely, again, because it's very prime core assets. And we've seen SORA over the last 6 months decline by 100 basis points. So that means there's a lot less pressure on capital values for commercial assets as well in Singapore, because borrowing costs have come off 100 basis points, essentially, for landlords and for owners of commercial assets. So because of that, we feel valuations as a whole in Singapore should stay firm, or if we saw our rental reversion for our commercial office portfolio was positive 9% for this past quarter. So if that continues trending up, then potentially there might be a slight improvement in valuation for our commercial office.
And you did exit your China operations, and you're now a completely Singaporean portfolio.
100%, yes.
Absolutely. And this was also because you saw those valuation losses actually out in China weighing on the portfolio. But with those valuation losses, could there be actually attractive attractive opportunities to come back into China, actually sometime in the future, if not maybe next year, maybe in the next 3 to 5 years, for instance?
I believe China, offers very good long-term prospects. Unfortunately, REITs, we are really very much judged on a quarterly basis, and it would take a while for the commercial office, we were in Shanghai, the oversupply situation to work itself out, but it will work itself out. It will just take a bit longer. So for the meantime, we think there are other more interesting opportunities to focus on. For instance, commercial office in Sydney, hotels in Tokyo, would offer more upside in the near term.
Okay. Financing costs also. This was a time when you actually took advantage of the better environment. Do you think that's going to persist? Because we have seen a lot of uncertainty introduced in the last couple of months, whether it be from tariffs or somebody not liking his central bank governor.
No, we believe, look, MAS monitors it closely, and it has come off because it's a function of currency and interest rates, and Singapore's a safe haven, right? And we see that with our tenants, the inquiries coming through, and obviously we see that with the appreciation of the Singapore dollar as well, because there's a flight to quality and there's a flight for safety as well, right?